Good afternoon. Today we are here to compare the similarity between two financial crises. The first one is the financial crisis in Asia 1997 to 1998, and the other one is the financial crisis in 2007 to 2008. And firstly, I will introduce, briefly explain what happened in the financial crisis in 1997 to 1998. The financial crisis started from Thailand and it spread out to other Asian countries. Thailand, in face of continuous speculative attack, turned out in inadequate usable foreign exchange reserves to stabilize its currency. And finally, Thailand had allowed its currency to float freely on 2nd of July 1997 instead of pegged to a basket of foreign currency dominated by the US dollar. And as a result, the currency instantly lost 15% of its value. This devaluation set off the chain of events that investors pulled funds out of Asia, which leads to the financial crisis.
Okay, so we'll talk about the financial crisis in 2007 to 2008. So credit crisis started in the US and spread several financial damage to the whole world. The crisis began when extreme high home prices in the US finally turned decisively downward and spread quickly, first to the entire US financial sector and then to the financial markets overseas. Even in Hong Kong, more than 20 billions of investment or Lehman Brothers related mini bonds became worthless after the crisis.
Okay, before going to the similarities between these two financial crises, let me introduce what is a bubble. A bubble is a situation where asset prices move because they are expected to move. In a bubble, the price moves away from the fundamentals based solely on expectations of further movements. Expectations become self-confirming. There are three phases of a bubble. Phase 1. Financial liberalization or expansionary policy fills a bubble. Then, phase 2. The bubble would burst and asset price collapse. Phase 3. Widespread defaults by leveraged asset buyers leading to a banking or exchange rate crisis and persistent recession.
One similarity of the two crises is the intervention by financial institutions and governments. The Asian financial crisis in 1997, the IMF provided financial support to the three of the most seriously affected countries, which are Indonesia, Korea, and Thailand. There was $35 billion US dollars of IMF financial support was provided for adjustment and reform programs in Indonesia, Korea, and Thailand. Monetary policy was tightened at different stages in different countries to haste the collapse of the country's exchange rate and prevent currency depreciation from leading into a spiral of inflation and continuing depreciation. The monetary tightening was appropriately temporary. Once confidence began to recover and market conditions stabilized, interest rates were lowered. Fiscal policy was essentially to be held firm in the case of Indonesia and Korea, while in Thailand, a fiscal tightening was planned to reverse an increase of the deficit of the year before the crisis. And there is structural reforms to alleviate the social consequences of the crisis and set the stage for resumption of growth.
And about the financial crisis in 2008, the aim of government's action was to restore liquidity and confidence to the marketplace and ease the financial crisis. There are three major measures were taken. The Federal Reserve is the first. It lowered the federal funds rate to provide liquidity to the financial system, expanded the range collateral it would accept in return for loans, allowed more financial institutions to borrow from the Federal Reserve. Secondly, direct injection of the capital to rescue prominent financial firms. Inject up to $100 billion into Fannie Mae and Freddie Mac, which is the housing agents going bankruptcy. The government received warrants to purchase 79.9% of Fannie Mae and Freddie Mac. injected 85 million in emergency loan to AIG. The government received warrants for the 80% in exchange and didn't rescue Lehman Brothers, allowing it to file for bankruptcy. However, the condition for all the added companies deteriorate. Thirdly, the boiled-out plan and 700 billion plan to purchase impaired assets from the balance sheet of bank by the government. 125 billion investment in 9 of the largest U.S. banking institutions and another 125 billion in smaller firms.
Comparing the effect of 1997 Asian financial crisis and the 2007 to 2008 financial crisis, the economic depressive effect of the 1997 financial crisis was mainly on the Asian countries, triggered by the international speculators, namely quantum fund led by the George Soros, brought out a tremendous amount of THB, focusing Thailand to take a feasible exchange rate, and thereby the nearby Asian country fell victims to the international speculators. Where free exchange rate was established, the eyes of the speculators were hunted at the Philippines, Indonesia, and Malaysia. Attacked exchange rate and bankruptcy were massive. The economic depressive effect of the 2007 to 2008, however, was globalized because of the burst of the housing bubbles in the USA regarding the crisis of the subprime mortgage. The massive sale of high-risk complex financial products all over the world received a failing return. Bondholders from all corners of the world had their capital liquidized in a flash with the close down of many international security selling banks, namely Lehman Brothers. The local fall in domestic product in US also led to global depressive consumption, as the USA took a dominant role in world consumption. More than a third, the recession in the USA and the interest saving rate among USA consumers caused decline in growth elsewhere, like 44.4 in Germany, 15.2 in Japan, and 7.4 in UK.
Therefore, the two crises have similar effects but different degree of influences. To conclude the similarities, first, there is excessive leverage by the financial institutions. In 1997, Asian countries accumulated short-term foreign debt without sufficient liquid assets, so reserve can't protect the domestic currency. In 2008, banks thought they wouldn't fail. Leverage ratio turned to very high and borrowed lots of money to purchase risky mortgage. Second, too optimistic to the market. Third, large bubbles formed. In 1997, large amount of quantities of credit pushed up asset price. In 2008, much capital investment in mortgage market and submortgage housing price raised. Fourth, companies shift their losses by defaulting debts. Banks suffered a loss and didn't get the help from government.